Hi guys. Today we will analyze Rockwell Automation stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a bad performer in the overall market. Both the long and short-term trends are negative. It is better to avoid buying stocks with negative trends. Strong support levels are around $191 and $168. Next strong support level is around $145. Strong resistance levels are around $220 and $252. Next strong resistance level is around $280. In the last month the stock has been trading between $190 and $218 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 1.2 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 5% per year, for last 5 years. We see that the average profit margin of the stock has been around 13% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 126% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Rockwell Automation Company: bad, average, and good. First scenario. Rockwell will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 8%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $71. Second scenario. Rockwell will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 10%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $98. Third scenario. Rockwell will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 12%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $130. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.5. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Rockwell Automation, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 22. Again, I will use 3 different scenarios for Rockwell Company: bad, average, and good. First scenario. Rockwell will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 18. In this case, the fair value of the stock today would be $60. Second scenario. Rockwell will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 20. In this case, the fair value of the stock today would be $72. Third scenario. Rockwell will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 22. In this case, the fair value of the stock today would be $87. As you can see, today the stock is overvalued, $200, even if we expect the company's high performance in future. While the company has a good profitability, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 5 to 6% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since January 2022, and it can go lower, before it recovers. I may consider buying the stock for the dividend, when the stock drops below $130. Company's strengths. Rockwell Automation is an American leading vendor for industrial automation services. The company supports companies across a broad range of manufacturing activities and enterprise digitalization. Its products include sensors, control systems and industrial control panels that serve customers in industries ranging from life sciences to electric vehicles. Rockwell will benefit from manufacturers focusing on supply chain resiliency. Revenue growth and margins should improve once supply chain disruptions fade. The company has a strong competitive moat thanks to its intellectual property, and to high switching costs for its customers. An increasing portion of the business related to software with recurring revenues is a positive for the stock. Rockwell is the only automation competitor that integrates discrete, process and hybrid manufacturing in a single easy-to-use platform. Newer initiatives, like digital twin and augmented reality, as well as software subscription services that deliver predictive analytics, should drive higher growth compared with historical results. Rockwell has a clean balance sheet and high-quality earnings, and is focused on boosting shareholder returns through both dividends and stock buybacks. The company's return on assets of 6%, return on equity of 24% and profit margin of 9% are amongst the best of the industry. Risks. Rockwell depends on suppliers to provide equipment, components and services, including finished products. Poor component quality, supply chain disruptions, and cost inflation may adversely affect the business. Demand for Rockwell's automation products and services can see ups and downs in the short term, as factory customers occasionally push their industries into overcapacity, and need time for demand to catch up to supply. The company operates in more than 100 countries, and thus faces risks related to international business conditions, trade restrictions, legislative and regulatory action, changes in tax rates, and unfavorable currency translation. Rockwell relies heavily on information technology in its hardware and software products and services. Despite the implementation of security measures, the company remains vulnerable to cyber attacks. Rockwell has an insufficient breadth of product offering in the industrial Internet of Things race, due to underinvesting in capital expenditures, for the sake of protecting profitability. Other risks include new competition, eroding pricing power and high inflation in input costs. The shares are not cheap, and higher interest rates do not support lofty valuation multiples. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 5 to 6% on average per year. The earnings per share is expected to grow by 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.